All right, what do we have? Apple up 5% on earnings beat and raised guidance. Hold on. Earnings beat? Raised guidance? Hey guys, my name is Michael.chin, and if you're like me when I first started trading, I had no idea what any of this meant. So in this video, I'm going to teach you how to quickly break down a company's quarterly earnings report to maximize your trading investments. All right, let's get on to the lesson. So as the name suggests, company quarterly earnings are held 4 times a year. They're aptly named Q1, Q2, Q3, and Q4. And they start around January and cycle every 3 months. So January, April, July, and then Q4 in October. Now, the purpose of these reports is to really give transparency between the company and the shareholders. Right? If the company is taking on heavy losses, then the investors have a right to know. And all of this information is bundled up in a report known as the 10Q. So you may have heard of a 10K before, and the 10K is an annual report that a company files. The 10Q is basically the same thing, but a condensed version of the past 3 months. So on a company's earnings day, they will usually have a press release, then the disclosure of the Form 10Q, and then around 20 to 30 minutes later, they may have an earnings call where upper management will discuss their 10Q with analysts and the general public, and then analysts are allowed to ask some Q&A questions about the 10Q. Okay, for those of you who have never seen a 10Q or a 10K before, I've pulled up Apple's 10Q here for Q3 of 2019. And remember, these are public documents, so at any time you can view these yourself. You can Google Apple 10Q and it should pop up in the search result. So this is a quick breakdown. I'm not going to get too deep into the 10Q, but the main things that you want to look out for are the financial statements. So that's where you'll find things such as the balance sheet, the income statement, and the cash flow statement. This will give you a good idea of how the financials are doing for a company. Then you may also find reports on the dividends. So they're somewhere in this 10Q. I don't know specifically where, but they will talk about their dividend report and how that's been doing. And then lastly, it also would be good to look at some of the forward guidance, or what they're called forward-looking statements, where management will talk about what they see for the outlook and on the horizon for the company. Now that we have a good understanding of all of the information provided to us by a company's earnings report, it's now time to piece this all together and identify the most valuable parts. So for me, I look at these 5 points, more so because as someone with a full-time job, I just don't have time to scrutinize the entire 10Q. Now, on the flip side, if you're a hardcore value investor, I can totally understand you going through the entire thing, and I have nothing against it. So here are the 5 main points that I like to look at. The first is the EPS, or earnings per share. Second is the PE ratio, or the price earnings ratio. Then I like to compare the company's EPS to the EPS assessed by the analysts. And then I also like to look at parts of the forward guidance statement. And then sometimes something might be brought up in the earnings call that may not have been talked about in the 10Q. And that can sometimes be important on understanding a company's future outlook. Okay, one quick disclaimer before we start getting into this. Remember to not take any of these in a vacuum, okay? There's no perfect EPS where I'm going to instantly buy a company, or there's no horrible EPS that makes me want to quickly liquidate my shares, okay? All of these have to be taken as a trend, right? If we see the EPS starting to trend down, then that might be alarming. And on the flip side, if we see EPS starting to rise, then that's a good thing. It means, the company might be more profitable. So EPS, basically this is the profitability of a company on a per share basis. We get this by taking the company's net income and dividing it by the number of outstanding shares. So recently, Amazon reported a net income of around 2 billion, and they have outstanding shares of about 500 million. So that gives us an EPS of $4. And if you take this $4, you might be wondering, wow, isn't Amazon going down? This is lower than last year. Well, like I said before, you have to look at the trend, and you also have to be realistic, right? One down day isn't the end of the world. Maybe Amazon is taking on some more debt, or maybe things are slowing down a bit. But you also have to be realistic too. Can a company continuously outperform their earnings every single year? There comes a time when a company just becomes too big and they have to go into some sort of consolidation phase. So with EPS, we can really see the trend of a company's profitability. But at the same time, we also have to realize, what state is this company in? Are they in their growth phase, or are they going back to a development phase? There's a lot of different factors that come into this, and that's why you can't use this in a vacuum. But at the end of the day, EPS does give us a good idea of the current trend of a company's profitability. Next, we have the PE ratio, or the price to earnings ratio. This takes the EPS one step further and relates it to the actual share price of the company to get the real, I have this in quotation marks, real value of the company. So we calculate this by taking the share price and dividing it by the EPS. So Amazon has a share price of around 1,800 right now, and for the past 12 months has had an EPS of around 22.5. So when we calculate this, we get a PE ratio of around 80. And what that means is that me as an investor am paying $1. Sorry, other way around. I'm paying $80 to get $1 of earnings out of this company. And so you might be thinking, that's insane. That's way overvalued. And to see a number like 80, that's what that would mean. I would look at that and say, wow, this company is very overvalued. But like all things, we have to look at the context. First of all, this is a tech retail company. And with tech, there's a lot of uncertainty. A lot of uncertainty on new development in the company, new technology that may be released. And all of this can create huge profitability if they're successful. And with that comes a lot of hype, a lot of shareholder hype, where people will pay the premium to see this company through. So a PE ratio of 80 does mean it's overvalued, but does that necessarily mean it's overvalued in the eyes of the investors? And for something like Amazon, currently at the moment, if it continues to trade at 1,800, then that means that the investors are content with buying it at 1,800. We can also look at the other side too. So for us, we're never really going to find a company that has a PE ratio of 1. That would mean that it's perfectly valued. Usually we find companies that are undervalued in the range of around 10 to 15. So if we do find a company that is undervalued and has one of these low PE ratios, and we know that the company is performing way better than that, then we should pick it up and buy it. At the same time, though, some companies do trade at around 10 to 15 on a normal basis. For instance, bank stocks typically trade at around 10 to 15 PE ratio. And why is this? It's because there's not a lot of uncertainty in the bank industry. They're very transparent with their operations, and there's not a lot of dramatic changes that can happen in that industry that would cause huge valuation growths or declines. To wrap this up then, just remember, if there's a high PE ratio, you might want to consider selling if the company is too overhyped. And then on the flip side, if there's a low PE ratio, you might want to consider buying if you know something that other people don't. Remember I talked about an earnings beat earlier in this video, where that's where the earnings estimate comes in. Before a company's earnings, analysts will try and predict the EPS of the company based on their forecasts, models, and market outlook. All of these predictions will be averaged out together, and that'll give us the analyst estimate. So for Amazon, the estimate was 4.88. And one way you could think about this is that if Amazon is trading at 1800, then that means the analysts are looking for an EPS of 4.88 to give Amazon that valuation of 1800. And well, we already know Amazon missed this estimate and they reported an EPS of 4.23. So what does this mean? Well, that means that Amazon was basically underperforming in the eyes of the analysts and in the eyes of the shareholders. And what this might cause, since they missed their earnings, is shareholders might have to sell their shares to reassess the true value of Amazon. So if Amazon's reporting 4.23, then maybe the shares are only worth 1,700 in the eyes of the investor. But we also have to go back and remember, we can't take any of this in isolation. Just because a company missed their earnings doesn't actually mean that the stock could go down. Remember, it's the value of the shareholder. And there's also other factors too. Amazon could give a statement on why their EPS missed, or they could give forward guidance on new things to look in the horizon that could offset this one miss. So use the earnings estimate as a gauge on how analysts are currently valuing a company. But remember, analysts don't have all the information. At the end of the day, the company knows what they're doing, and that's what you need to dig deeper into. Lastly, there also might be valuable information in the forward guidance and earnings call. So a lot of the information that they put on the forward-looking statements are things that really can't be assessed on the financial statement. So for instance, a company like Uber, which have the most horrendous financial statements, might try and slip in their research on autonomous cars and autonomous ride sharing. And what they're trying to do here is they're trying to present value to their shareholders that really can't be appraised on a financial statement. And so it's up to you how you want to take these forward guidance statements, but they can tell you some things about the company that can't be presented in dollar values. And there's also the earnings call too. That's where upper management will come in and summarize their 10Q and then take questions from analysts. And for big companies, this usually isn't a problem, but sometimes management may show a lack of confidence in the way they speak, or they may even slip up. So there's times in earnings call where management will disclose things that they weren't supposed to talk about, or disclose things that weren't in the 10Q, and this can drastically change a shareholder's perspective of the company. So while I don't look at these all the time, sometimes something pops up in the forward guidance or the earnings call that can be pretty important to your understanding of the company's share value. So now you should have a good understanding of how to evaluate a company's quarterly earnings report. If you have any questions about the content, please feel free to comment below and I'll be happy to help. If you like this kind of content and want to see more, definitely subscribe below and I'll see you in the next video.